you're going to see the price of silver not just at 200, but probably 3 to 5. Who did better? The guy that tried to get out probably didn't get out at the high. Maybe you get out in the middle of the sell-off. The question is, when did he get back in? Or did he? You buy those breaks. If you bought the break earlier this week, 12.4% drop. If you bought that break, you got down to 103 or something like that. Right back up to 121 next. Then we dropped to 106.90, and next thing you know, you rally $8. There will be a correction, but don't let it confuse you. But it's still cheap at 2% plus. Gold will already be much higher, and silver probably be several $100s by early summer. The clock just began starting December is month 1, January is month 2. Okay, we're 2 months into a probable couple quarter surge. But in each of those cases, and probably in this one, there will be a midpoint about in the middle of that time clock, not in the middle of the price move, okay? And after that, we're not going to crash. Yes, you could have sharp corrections at some point, but you'll be in a new reality. Instead of 4 to 50 and 4 to 50, you'll be in some reality like 200 to 500 or something like that. What silver's doing now is not a normal bull market. And so people who are applying the normal metrics like, oh, it's overbought, et cetera, throw it out the window. This is different. This is not a normal bull market. We're in something bigger, not just the fundamentals of silver particularly, but the fundamentals of monetary metals. The technicals for silver are unique, and they're going to get corrected meaning to the upside. Silver's vastly underpriced to gold historically. It's now resurrecting itself, and it's going to do it rapidly. We suspect that much of what you're going to see will be accomplished by, let's say, early summer. So let's say early third quarter. At that point, we would get more cautious about it, but I strongly suspect you're going to see the price of silver not just at 200, but probably 3 to 5. Okay, now there's reasons for that, but we can get into them if you want to. But my main message to people is now, yeah, it's been great to come up to here, but it's trivial. Silver's in a move to a new reality. Treat it as such.
Now, a lot of technical analysts out there, investors that we've been talking to, are talking about exiting silver. A lot of people already have at these levels. What do you make of that?
Jim Cramer on CNBC says, sell it, it's overdone. Okay. Therefore, we know it must be true. Again, don't apply old norms to silver. This is different this time. Silver has been, I'll throw out a couple of examples. These are just price-based, not our momentum work, but it's in-your-face type historical data. As silver has stayed confined in a 50-year range up until like 2 months ago, up and down, between $4 and 50 and so forth and so on. Nice dimensions. I mean, it was a 10-fold move from the bottom of that range to the top, and the bottom of the range to the top. But why was it confined? 50 years. Gold wasn't confined. It made a high in 1980, took it out vastly in 2011, and took that high out again. You can even look at copper and go back to 70s, 80s, 90s, 2000, up through about late 2005. Copper had been in a lethargic old reality of 50 cents to $1.50, 50 cents to $1.50 a pound. Up and down, up and down. That was its reality. But in 2005, late that year, it broke out above that. I'm talking just simple price now. And in a couple quarters, it had fourfolded up above $4. Okay, boom. Like that. It didn't take 2 years to get up there, but it said, hey, I don't belong in this old reality. Certain things have changed. I mean, you can throw out one of the major things that's changed constantly is the decay of the money in it, the buying power of the U.S. dollar. You look at the quantity of dollars created every decade, and it's sure enough, that's why a loaf of bread used to cost 20 cents, and now it doesn't. Okay. So copper said, no, I'm going to a new reality, and it did it in a couple quarters. And then you look at lead, which was in the same type of situation as copper for multiple decades, just up, down, and in this definable old reality. And in 2007, year and a half after copper had done its thing, lead broke out, and again, like quadrupled in a couple quarters to a new reality. And after that new reality was reached, it sold off some, but it stayed in a higher reality than had been the old one. Same with copper. Okay. And then you look at gold, the mama monetary metal, and it hasn't been contained in a range. In fact, it's its bear market lows to bull market highs have been eightfold moves, 1976 to 1980, 2001, 2002, up to 2011, an eightfold move, multiple gain. Right now, we're only fivefold. So right now, even gold hasn't matched the dimensions, but it wasn't confined in a box. It was higher highs. Okay. Silver finally says, me too. Okay. But when you value silver versus gold, like do a simple thing, divide an ounce of silver into ounce of gold, and plot that. And early last year, it was down at 1%. Ounce of silver to an ounce of gold. That's like free. Okay, historically very cheap. And now it's up above 2. That's a major move. That's a doubling in the relative value of silver to gold. But it's still cheap at 2% plus. Because if you go back and look at the price range for 50 years, 2 peaks at $50. But look at the spread range. Where was silver in 1980 versus gold? 6.5%. And then in the surge in 2011, when it again reached $50, it was 3.1%, the price of gold. Right now, we're still 2%.
The ratio tells a story Wall Street would rather ignore. Silver isn't expensive. It's mispriced. Michael Oliver highlights the silver to gold ratio, which collapsed to nearly 1% last year, a level reached only during periods of extreme distortion. Even now, at just over 2%, the ratio remains far below historical norms of roughly 6% to 12%, suggesting the repricing is far from complete. Gold has already gone through multiple eightfold cycles. Silver hasn't even achieved half of that relative move. Institutions tend to avoid ratios because they reveal imbalance more clearly than headlines ever could. For investors, ratios strip out emotion and clarify whether a move reflects exhaustion or simple normalization. The silence surrounding this metric is revealing. And what Michael Oliver points to next may explain why this gap could close faster than portfolios are prepared for.
So it's our working assumption that don't be surprised, in fact, expect that not only will silver seek a new price reality, but that its relationship to gold will at least re-achieve those old relationships to gold in terms of relative pricing. In other words, huge gain from here. So as gold continues up, which we think it will, is now in accelerated mode, obviously, silver will be even more so. And there's a lot of other reasons here, but so if you're long, don't look at it as, like 1980 run up or 2011 run up and, got to take those profits because we're going to collapse again. Don't apply the old norms.
This isn't a replay, it's a reset. Michael Oliver's central point is that silver isn't topping out in euphoria. It's advancing toward a fair relative valuation versus gold. Previous cycles ended in collapse because monetary tightening followed. Today's environment is the opposite. Debt saturation and liquidity stress, not restraint. Historically, when gold accelerates, silver tends to respond even more forcefully, driven by thinner liquidity and higher sensitivity to leverage. Investors treating this as a 1980-style risk are likely selling into strongest part of the structural move. Strategically, this argues for staggered exposure and patience rather than tactical exits. History is unforgiving to those who mistake volatility for reversal. And what Michael Oliver signals next helps explain why this phase may resolve in stabilization, not collapse.
Gold will already be much higher, and silver probably be several $100s. And by the way, I still think it's going to occur mostly by early summer.
One of the things that has highlighted the gold and silver markets, especially the silver markets over the last couple weeks, months, is the volatility in both directions, right? You're seeing today, for example, silver was at 120, it dropped down to 106 or something like that. So you're seeing these huge price swings. Gold dropped like $300 or so from its high. So do you anticipate that to continue? And what do people should expect from here?
There will be, I think, our assessment is that there will be a correction in the middle of this move. Now, how do we define when this move began? It's when the spread relationship between silver and gold broke out. Now, already gold and silver have been going up for a couple of years. Okay, no big deal. So it's not like they suddenly became bull markets. But back in November, When you divided the price of an ounce of silver and an ounce of gold, it cleared a massive ceiling of prior resistance on that relative performance chart, on the spread chart. So when you plotted silver versus gold and went back like 10 years, you'll find, oh, it keeps stopping at this level, keeps stopping at this level. Very shallow level, by the way, but a technically definable ceiling.
The real signal here isn't silver's volatility. It's the structural break quietly unfolding beneath it. As Michael Oliver has long argued, relative performance breakouts often matter far more than headline prices. That's exactly what's happening now. A $300 pullback in gold or a 12% drop in silver feels dramatic in isolation, but once decade-long resistance is decisively cleared, those moves become background noise. Historically, volatility expands after regime shifts, not before major reversals. For investors, this reframes risk entirely. The threat isn't price fluctuation. It's mistaking a structural transition for a topping process. What he hints at next explains why waiting for calm may end up being the most expensive mistake of all.
When we closed above that in November, we announced, okay, the same event, technical type signal occurred in 1979, just prior to silver gushing from like $15 to 50 in 5 months. Think of the percentage gain there. And in September 2010 through April 2011, it went from 20 to 50 in 7 months, either side of 2 quarters. So once that unleashing occurred, where silver said, no more, I'm going to seek a fair value to gold, that's when the price gush really occurred in silver. Oh yeah, gold kept going up all during that time. It wasn't an issue of gold going down, silver going up. It never is. Silver exploded versus gold, but it did it in a couple quarters. And we found other insights, like I mentioned, copper and lead, for example, when they took out those price ranges. When did they accomplish the meteoric move? In a couple quarters. Not 3 years, not incremental, but vertically. I think that's where we are. In which case, the clock just began starting December is month 1, January's month 2. Okay, we're 2 months into a probable couple quarter surge. But in each of those cases, and probably in this one, there will be a midpoint about in the middle of that time clock, not in the middle of the price move, okay?
This comparison shows just how deceptive long-term trend language becomes once compression finally breaks. Michael Oliver often stresses that historical analogs only matter after resistance gives way, not before. The 1979 and 2010 episodes are harsh reminders. Silver didn't grind higher. It violently repriced within 2 quarters, even as gold continued its advance. The uncomfortable truth for investors is that markets don't move on comfort schedules. They move on structural clocks. If this is only month 2 of a 2-quarter surge, hesitation isn't caution, it's exposure. And what he points to next directly challenges the idea that corrections automatically equal safety.
That you'll get a shin kick that doesn't just last a day or 2, but maybe you get kicked and you don't make a new high for 4 weeks or so. In other words, what you could call a correction or at least a solid stall. So far, you'll notice in this past 4 or 5 days, we've had 2 12% collapses in silver. From traded high to low, usually within hours, just like today, 121 to 106.90, bam, like that. And all of a sudden, you close out the week around 114, 115. Solid up week, massive up week. And as far as the month goes, with the day left, we closed last month at 70. Think about it. Let's say we closed the month here, 115, and people are complaining it's topping. Give it a chance, and we think probably, yes, there will be a midpoint correction, but we're urging our subscribers that when we try to identify that, and maybe we'll try, don't even apply it to your investment positions, because you could mess yourself up pretty badly in terms of getting out, because then when you get back in, instead, if you're heavily in calls or time or leverage positions, then maybe you should act on that correction thing. But in both of those run-ups in 79 to 80 and 2010 to 11, once you had that correction in the middle of both of those, what was on the other side was even more than what had happened up to that point. So
This is where psychology quietly wrecks portfolios. As Michael Oliver has warned, violent pullbacks within a structural uptrend are engineered to provoke bad decisions, not to signal failure. Two separate 12% intraday collapses feel catastrophic in real time until you step back and see silver on track to close the month up roughly 60%, from 70 to 115. The real risk isn't the correction itself. It's selling spot holdings in fear and then failing to re-enter as price accelerates higher. Leverage is a different game, but core positions demand discipline. What Oliver emphasizes next makes the point clear. In major trends, patience, not precision, determines outcomes.
You get the point.
Over the course of this last year, I think everyone has been waiting for a pullback, and really like 2 years for gold. And if, for example, if they were waiting at 2,800 for gold, they're waiting for a pullback, it goes to 3,100 and then pulls back to 29, right? So it's like, okay, well, that could happen in silver as well. People waiting for a pullback, it goes to 150, pulls back to 130. Well, it would have been better maybe just a dollar cost averaging on the way up, or buying now versus, it's possible, versus waiting for that pullback, because it could be much higher, even the pullback from here.
Yeah, over the last 6 months, we've told subscribers, instead of flinching at every 10 to 15% pullback, reverse. Buy every 10 to 15% pullback. And if you go back over the last few months and find any 10 to 15% pullback and circle it on your price chart, then ask yourself the question, who did better? The guy that tried to get out, probably didn't get out at the high. Maybe you get out in the middle of the sell-off. The question is, when did he get back in? Or did he? Okay, you buy those breaks. And so if you bought the break earlier this week, it was a 12.4% drop. If you bought that break, it got down to 103 or something like that. Right back up, 121 next. Then we dropped to 106.90, and next thing you know, you rally $8. Okay, so there will be a correction, but don't let it confuse you.
This quietly dismantles one of retail investing's most dangerous myths, the perfect pullback. As Michael Oliver often emphasizes, disciplined accumulation consistently outperforms emotional timing, and gold makes that case unmistakably clear. Those who waited at 2,800 missed 3,100 altogether. Even a 10 to 15% correction from much higher levels still leaves late buyers chasing strength, not value. Dollar cost averaging through volatility isn't passive behavior. It's deliberate positioning during a repricing phase. The data consistently rewards action, not hesitation. And what he points to next explains why confusion remains the market's most effective weapon.
I think we're going to run the course probably by summer, and most of the course. And after that, we're not going to crash. Yes, you could have sharp corrections at some point, but you'll be in a new reality. Instead of 4 to 50 and 4 to 50, you'll be in some reality like 200 to 500 or something like that. But we're going to go to the new reality first, and that's the main thing. If you want to be there, don't flinch prematurely. Don't listen to all the talk about, this is just like 1980. No, it's not. Different situation here. If you think gold's going a lot higher, and I think it is, because this time we don't have the kind of situations we had in 1980 or 2011 in terms of the macro fundamentals of monetary metals. We have a government debt crisis, not a mortgage crisis, not a dot-com bubble. We've got a government bond crisis. And everybody knows we got one in Japan, but we got one too. And back in November, I probably said this before to you, President Williams of the New York Fed said, the Fed's going to start buying bonds, quote unquote, okay? But he said the reason was to provide liquidity. That's cute. Okay, what they're trying to do is support that market. And if you look at long-term bond futures, 30-year bond futures, right now they're trading 114, 115 area on price, 114, 115. And yields are holding at high levels and price is holding at low levels for 3 years now. So they can cut short-term rates all they want. It hasn't affected the long end.
The real warning here isn't about upside price targets. It's about how casually people lean on past crash analogies and why that's dangerous. As Michael Oliver has argued, the current move in metals is being driven by sovereign debt stress, not speculative excess. That distinction matters far more than any headline forecast. In 1980 and 2011, tightening cycles eventually crushed momentum. Today, the opposite is happening. Long-end yields remain stubbornly elevated even as rates are cut and bonds are bought. That's not market noise. It's a signal of structural failure. For investors, this changes the framework entirely. Pullbacks aren't the end of a bubble. They're pauses within a broader repricing cycle rooted in debt credibility, not froth. And that's exactly why what comes next points to the bond market as the true accelerant.
And there's a lot of companies out there, especially in commercial real estate, and some banks are vulnerable to this choking high yield, high rates. It's not coming down. And the T-bond market itself doesn't look good. It doesn't look healthy. Our technical analysis of the T-bond market says, and it's bigger than the stock market, by the way, you don't want to slip about 3 more points from the recent lows we've seen in T-bond futures. And by the way, since they started buying in November, T-bonds have come down in price, up in yield. So it hasn't helped stabilize that market. May have slowed its decline, but it hasn't stopped it. You drop about, 3 points below where you are now in prices, and you're gonna spark a sharp sell-off, a rise in yields. And that's gonna panic the central bank, because then all of a sudden there could be a global perception that, yeah, we know all the Western world government bond markets are not in good shape, and Japan's in a panic mode. And if all of a sudden another one looks like it's not only not in good shape, but looking like, it's very risky, then suddenly you get arms in the air. And what's the alternative? Well, Morgan Stanley said so a couple months ago. You know that. It's almost worth a chuckle. Instead of the 60%, 40% bonds, 60% stock portfolio balanced, so-called, it's now 60, 20, 20. Gold is 20. Okay. Heck of an admission, but a good admission that the old reality doesn't work anymore. Bonds are not the alternative. In fact, the only thing wrong with his statement was the balance percentages.
This section lays bare how fragile the so-called risk-free asset has become beneath the surface. As Michael Oliver has warned, T-bond futures only need to slip a few more points to trigger a yield spike that policy tools may be unable to contain. Despite the Fed stepping in with bond purchases since November, prices continue to fall. That's a clear signal. The problem is structural, not cyclical. When Morgan Stanley publicly walks away from the 60-40 model, it isn't innovation, it's an admission. For investors, the implication is stark. Traditional diversification is failing precisely when it's needed most. The next point explains why central banks may lose control far faster than markets expect.
But anyway, that's where we stand now. So we have you've got to watch the government bond market, because that's a potential crisis beyond any. That's a nuclear event. And it's dancing on glass. And we're arguing technically you drop about 3 more points in the bond futures. And I suspect they're going to do it. Question is when. This month, next month, or the following month. I think soon they probably will. You're going to have a noisy panic. The central bank will go berserk in terms of, print. They got to save that market. They can't let it catch fire. And the public can't take it in terms of, sense of stability, And that's what's helping drive gold, because I think it knows it's coming. And so everybody's looking for, why is it going vertical? Well, look at the government debt markets. Anyway, that's where I think we stand. And right now, I think by the time the public becomes aware of that crisis fully and panicked by it,